reloading WebEx. That didn't solve it.
It's all right. We'll handle it just with audio. Okay, it is
Great.
4:08 and we are calling the meeting to order, meeting of the OVSD Finance Committee on the 10th of February, 2025.
One of the
Any
things,
public comment?
before we do that, one of the things that would normally be item number 2, but I failed to put it on here, being the first meeting of the year, is we've got to have a chairman. So if somebody wants to volunteer or nominate for chairman of the committee.
Comfortable, Steve? Fine.
Okay, so it looks like Steve's going to be the chairman of this committee for this calendar year.
Okay,
so
great.
actually,
That works out just
Today
fine.
is probably the 2449 stuff.
Yeah, so when did the call the meeting to order, and then I'll state that Director Quillisi is here in person, Director Berg is here in person, and then we have Director Martinson that has notified me in advance of the meeting he'd like to address the board to request approval of attendance. So
Fire away,
Lowell,
Lowell.
Should I request that now?
This is the time.
Okay. So I am in Colorado at the present time due to some health issues with a grandparent. So I unfortunately was planning to return on the 9th, and it now looks like it'll be the 23rd. So anyway, I request dispensation to be able to attend remotely.
Fine by me, Randy.
Yeah, I'm good with that. Do we have to make a motion?
You don't. You can just say that you're good.
Accepted. You're in.
All right.
Good. Okay, public comment. Did we have any public comment, written or electronic? Good. And the next item up is presentation from PFM Asset Management on the district's investment portfolio. I see we have a gentleman here with us. If you'll introduce yourself and give us the talk, sir.
You go ahead. Well, good evening, everybody. Just to kind of start it off, and before I introduce myself, Scott, am I able to share screen, and will you be able to see it clearly?
Should be able to.
Okay, awesome. So my name's Robert Montoya. I'm an institutional relationship manager here with PFM. Take care of our Southern California clients, and with me today is, I'm sure you're familiar with, Richard Babby, who's been with PFM for some quite time. So I'll let him kind of intro, and we'll go from there.
So like Robert was saying, I'm one of the other institutional relationship managers who support the account. So we work in combination with supporting the district. Robert, do you want to start?
Yeah, so let me go ahead and share my screen here. And if Scott, if you could confirm, can you see the screen well?
Yes, we can see it.
Okay, perfect. So let me close this out. Get this in the full screen. Okay, there we go. All right, perfect. So just to kind of start us off, a few things to keep in mind. PFM has kept the objectives of the district, keeping safety, liquidity, and yield in that order, those things in mind. Given the district's liquidity needs, things have been declining for a bit, but that's been discussed over investment decisions over the past 5 years. Just looking forward with the economic update, I'll dive into that right now. But just something to keep in mind is interest rates have remained above their 20-year average. So that's despite the reaction to the Fed cuts that we saw last year. So going on to the market update here. Okay, go back here. All right. So kind of giving the broad perspective on the Fed's dual mandate, this quarter we opted to combine the inflation and labor market condition story into one slide. As we move forward with all these slides, you'll see quotes from the December FOMC meeting. So on the left-hand side here, we have core PCE as well as the headline inflation number, which is CPI. PCE is the Fed's preferred gauge of inflation. And at the end of the December meeting, the Fed said that they would continue to see inflation um, being broadly on track to
Target.
come down. Given what we've seen, the Fed has been a bit more hawkish as of late, which they are prioritizing controlling inflation. One thing I did want to note on the unemployment rate on the right-hand side is that compared to what we've talked about before in the third quarter, it seems like the downside risk of the labor market seemed to have diminished. The year ended at a 4.1% end of the year unemployment rate, which continues to be well below that 25-year average, which I just mentioned, at which is a 5.7%. Just to kind of add more perspective on this, the unemployment rate for January was its lowest since we've seen since May of last year, and that was at 4.0%. And a lot of that has to do with the labor force participation sort of stepping up. To add another perspective, if you think about where the Fed thinks maximum employment is broadly, people kind of assume that it's 4 to 5% range. We seem to be at that mark, and it's strong by a strong jobs market report of December. One last thing I wanted to highlight on this slide is just if you look at the light blue line here, core PCE sort of stalled towards the end of the year, but overall it was seen as a good indicative going into 2025. I'm going to switch over here to the next slide. And so there are 4 areas of policy that we are monitoring, which is taxes, tariffs, immigration, and regulation broadly. We know that any of these policies will impact growth, inflation, and the deficit, and for some, the labor markets as well. And particularly, for example, tighter border policies could have negative impacts on the labor markets. And in general, the current assumption is that we'll see higher deficits going forward, higher inflation going forward, and in general, stronger growth. The markets do continue to react to news, and it's still a bit unclear as to the direction we're headed. I like to tell most of our clients, I've already said, the next 100 days will provide a little bit more clarity in terms of tariffs, policies, and where we're heading in that direction. In this slide, and particularly on the right-hand side, is the month-over-month percentage change in sort of the value of consumer spending, which has been adjusted for inflation. It shows how much consumers have increased or decreased spending in November compared to sort of an average of previous months. You can see that there was an increase in spending, and a lot of that could be attributed to the fact that there are worries about price increases coming this year. And the graph below here, it's actually really interesting. I like this graph because it shows a word count from earnings releases that mention the word tariffs. Some companies have began to know and anticipate increased prices, and of course tariffs and how this would impact their suppliers and operations and things like that. One thing that came out of a meeting we had this morning actually was there was a 25% tariffs on steel and aluminum. There's more to be announced this Tuesday and Wednesday, so tomorrow and Wednesday. This has been applied to every nation exporting materials to the U.S. There's, the bigger impacts is towards Mexico and Canada. There was a call also scheduled with China that's been delayed, but it's hard to call what direction we're heading in that sense. I know last week the tariffs were used as a negotiation tactic, so it'll be interesting to see what kind of happens over the next couple of weeks. Moving over to the next slide here. Just a broader theme is the soft landing probability still remains on track. We've probably avoided a recession. If you look on the quote on there, it says we've avoided a recession. I'm adding the word probably in there because you can never be too sure. I know Fed Chair Powell was, but things could always change. There's a wide range of forecasts for inflation, but again, the story going forward is where does inflation land? Looking at this graph, the estimate on the GDP forecast annualized rate was of 2.3%. That's actually did come in at 3.0%, which is a little bit higher. Largely, this is driven by consumer strength, which has driven the GDP growth and the expectation setting up 2025 in a good way. Again, the chances of a recession remain low in this sense, but we'll continue to kind of monitor that. Economists aren't necessarily expecting a drastic increase in inflation this year, but again, there's a large range where, as you can see in that shaded area forecast of GDP, there's a very strong number that came out of the third quarter. and setting up the moderate, kind of setting in that line perspective heading into 2025. Not on this page, but I did want to mention this. Consumer spending again does remain to be strong, particularly in income with households that are high income households, mainly because of growing wealth, as we like to say. Lower income households kind of are a bit more cautious, dealing with tighter lending standards and a bit more focused on necessities like groceries and rent. Moving over to the next slide here. So these projections are released 4 times a year. Here we're comparing the September projections. On here, the medium economic forecast kind of shows a higher inflation forecasted through 2026, a lower path for the unemployment rate, and a higher GDP growth this year in 2025. Some policymakers incorporated potential effects of tariffs on these projections, but we don't have insight on who or how much of it was used on these projections, but it is important to note, given the higher projections of December. Despite this, it is still consistent with the overall inflation view of the FOMC meeting, following the theme that's been sort of been alluding the Fed and kind of going forward. So just wanted to highlight here this. This slide kind of leads into the next with the Fed's latest dot plot. So again, this is another kind of chart that's released 4 times a year. It's essentially an anonymous snapshot of each of the 19 committee members and where they project the Fed funds rate to be in the future. Each dot actually represents each of the policymakers and people who are voting. If you look at the 4 dots right above 2024 that are sort of out of the crowd there, that actually represents 4 policymakers that were not in favor of cutting rates. So you can kind of see that kind of change in motion started early in December. And the light blue line, as you can see here, it's kind of a median projection of the December meeting, which is above the September line, as you can see. One thing I did want to highlight here is the Fed now is anticipating only 2 cuts in 2025 versus the 4 cuts that the Fed previously anticipated. That's quite a change from what we were seeing in 2024. If we would have met last quarter or the previous quarter before that, there was talks from the Fed saying, there might have been 4 cuts. I know the markets were pricing in 6. So the last couple of weeks of December, and especially now in January, that whole mindset has sort of shifted. But still, longer term, that 3% range is still the goal, and it does seem to be, or as from the Fed's perspective, in line to kind of hit that number.
You could draw a line that goes down to 3%.
Right. Going on to the next slide here, or let me see here. Going. Okay. Sorry there, the screen is moving a bit too quick here. Okay. So this slide actually does provide a good perspective on how things have looked throughout the year. Each of the shading areas, and then we're talking about 2024, actually represents kind of each quarter that we had this past year. In a typical cutting environment, the expectations are that the rates will be lower going forward. And what we've seen from the 2 years is that it nearly ended unchanged. The 2-year actually landed where it started. A lot of that has to do with the view of sticky inflation and not many cuts in 2025. So as I just mentioned, things drastically changed in December, which kind of put us back to where we were in the first place. So that's actually a really interesting note from this past year. And then that brings us to the yield curve here, which has actually started to change. So at the end of the September, the yields were much lower, mainly because they were anticipating more cuts given the 50 basis point cut that we saw in the September meeting that we saw last year. But now we see a different yield curve with the lower end of the curve as expected has come down alongside the Fed rate. The difference between the 3-month and the 10-year has become positive for the first time in 2 years. The curve is steeper. It's anticipating it will be continue to steepen with longer end. The longer end actually does sit on top of its 1-year range. So if there's one thing I can add on here, it's a good opportunity to capture some income today if you have that opportunity. But the yield curve, has continued to disinvert in a sense.
10-year rate is higher than the 1 year?
What was that?
Sorry, the P is a little hard for me to read. The 10-year yield is higher than
Yes,
1 year
then
solid line.
yeah, so rates out longer are higher than shorter end. I don't know if you could hear me.
Q.
Okay. This slide here, it's a great slide just to kind of read over. I won't go too much into detail into this, but it's a good read afterwards, just kind of highlight in a high level what I've spoken of today. But kind of given this, I'll hand it over to Richard to kind of talk about the portfolio here. And I'll switch it
Thank
over
you,
to you,
Robert.
Richard. I'll control the slides. It's kind of janky, but I'll keep a hold on it.
So in this section, what we want to do is give you an update of what the portfolio is at this point in time, but it's very important to see where we are in the portfolio. So on this slide, we're showing you the month-end balances as of December 2019 through December of 2024. We actually started working with the district in February of 2019. So what you can see is that the balances peaked in December of 2020. However, since that time, given cash flow needs and other considerations, the size of the portfolio continued to draw down. And what we saw is that in December, and it's about the current level right now, is we're a little under 8 million of managed assets, a little over 8 million with everything included. If we go to the next slide, we're now looking at what the portfolio is as of the current time. Just to provide you some context, in the chart in the upper left, we're showing you as of the prior year. So what we do is, again, we saw the balances decrease and the duration of the portfolio, meaning similar to its average maturity, continues to shorten up. Because what's been happening is, given liquidity needs, our focus has been providing liquidity rather than reinvesting investments out farther. If that's still the key aspect of what your needs are, we'll continue to focus on that. Once those liquidity needs have been met, and if you had additional liquidity funds available, it would be a good time, as Robert was indicating, to invest out a little longer and capture some yields that you could hold on for a while. The bottom chart, the blue, shows you the maturity distribution as of 2024, and the gray shows you as of 2023. Again, a general shortening of the portfolio, given the need for liquidity and the need to not reinvest new securities. If we go to the next slide, this we just want to show you the same information in terms of total balances, but to indicate where the investments are. So everything above the security subtotal is the assets we actually manage on an active basis. The bottom line, CAMP, is the liquid balances that cash goes into until it's needed. The key thing that I want to indicate is balances have decreased across the board, as we had talked about, because of liquidity needs. We've also seen a little market value depreciation in the latest year, just because interest rates ended the year basically a little higher overall than where they started. If we go to the next slide, this is just saying your portfolio is in compliance. If we go back one, this is showing you the, go forward, this one. This is showing you the earnings on your portfolio on an accrual basis. So this is just looking at actual interest received or interest accrued during a period. And what we see is that the balances have been sort of stable. I mean, the earnings have been sort of stable over the past couple of years because we've actually had to sell some securities at a loss to provide liquidity in a time frame when interest rates were rising rapidly. When interest rates rise, the market value of existing securities falls. So this is just basically the story. Then if we go to the next slide, is to show you the portfolio's performance on a total return basis. So including the actual realized earnings or gains and losses, this is including the change in market value. And what we've seen is that the portfolio being shorter has actually performed a little better on a total return basis because it has had less market value depreciation, but it's still been impacted. But if we look at the 1 year number, really focusing on that, on a total basis, your portfolio in the past year has returned 4.54% 5.54% over the past year, 1.13 relative to the benchmark that was set out at the initial time frame. If we look over longer periods, the returns are lower, but were higher than the benchmark. Given the fact that interest rates were rising, total returns went down. And that concludes this part of my presentation, unless you have any questions.
What's the benchmark?
The benchmark is the Merrill Lynch 1 to 5 year US Treasury Index. We really haven't been able to manage to that over the past couple of years, but that was the benchmark that was initially used. So we use it as, until there's a change, that's what we continue to report against.
So I'm on the phone. Sorry about that. When you say you manage to liquidity, what percentage of our portfolio roughly are you managing to liquidity versus trying to get higher returns? All of it? Some of it?
I would say all of it over the past couple of years, especially. The liquidity needs have been so high that has been our focus rather than managing assets to increase the yields. Some of it was uncertainty, and again, just wanting to make sure the liquidity was there and when it was needed. Was that responsive to your question?
Yeah, but it kind of goes to the next question, which is 2 years ago, I believe our total portfolio was somewhere around 15 million. Is that right?
It
Something like
was,
that?
if you, 2 years ago, December of 2022, it was 18.5 million.
Okay, and we have used about 10 million of that over the last 2 years, is I think what you're telling me, right?
Correct. That's a rough number, yes.
Okay, so during that time, and this is more a question to the board or the group, but we knew what our liquid needs were going to be relative to the new nitrate elimination plant. What we did not know was the needs for the storm damage. And so just kind of a philosophical question, we could have, during the last 2 years, managed roughly half of our portfolio along the lines of needing liquidity, and the other half more along the lines of, trying to maximize return on the amount we had. So the question I'm having for our group is, going forward, do we really think we need to manage 100% of our portfolio as liquid versus some percentage as liquid, and try to get as much out of our principal as we can in terms of return on interest or whatever else? Because what many of you know, what triggered me on this is when we did our budget last year, we assumed 100,000 a year return on all of our on our portfolio, which was about 100,000 a year in the budget. I'm making almost that much on a fraction of the portfolio during that time. So it really struck me as being very odd that we were managing our money, in my mind, so poorly. But so what I'm trying to figure out is there a way? I think right now we can put about 15% of our money in CDs, for instance, which at 4 or 5% should be, 70,000 a year just on that 15% of our money, let alone whatever we're getting on the other 85% of our portfolio. So anyway, what guidance would you need from us to tell you to manage it slightly differently? And what things would you advise us on before we make a decision that we want to do it that way?
Well, actually, I'll reverse the order of your questions. The key aspect from our perspective is, first, financial plans drive investment. So the key aspect first for there is, since how much you're going to need and when are you going to need it becomes the key determinant of of all of the investment plans. So if you said, hey, you have $4 million you're not going to need for an indefinite time, that would be the type of things that we would look to move out farther on the yield curve, lock in higher yields, do things like that. But if you said our uncertainty is beyond 12 months, we really don't know how much we're going to need and when we're going to need it, we would take a different strategy and say, emphasize shorter term investments, whether they be CDs or whether they be the pools, Leif, Camp, and the Ventura County pool, to say that would be the better approach. So again, once your financial plans are set and when you have a firm idea of when the funds are needed and how much that would be, we could provide specific advice on what the best option would be given those parameters. Did that respond to your question?
Yeah, that makes sense. So now the next question is, if I'm dominating the conversation, if somebody else wants to ask them, please do.
Go ahead, Lowell.
Right now, what I'm wondering is, when we talk, let's just say the simple case of CDs. Right now, we can get, 4.5%, maybe 5% interest on some CDs, 4% easily on almost every CD. So, and there's a range of, 3 months, 6 months, 9 months, a year further out. Is there any, in terms of liquidity, let's just say we wanted to put 15% of our, our portfolio into CDs. Then the question goes to what you said. Okay, well, how long are you going to be able to do that, depending on when you're going to need the money and how much of it you might need? And so, is there anything that limits us from putting money into short-term CDs, 3, 6, 9 months type
No.
stuff? I'm not aware of anything that does limit us.
There's no limit on that. The government code would allow up to 30% if they're negotiable CDs. If they're just bank CDs, time CDs, collateralized CDs, you could put 100% of your money under it per California government code.
Okay, so I think the 15% I got out of our own internal sanitary district rules somewhere I read some time ago. So here's the thing I'm thinking is, if we made an estimate, a guess, that we could in fact put half of our portfolio into longer term or into higher yield investments, and if we put those into a year or less type instruments such as CDs, the penalty might be, if all of a sudden we did need that liquidity, is that we might have to cash those CDs out a little bit early.
Penalty.
And so we would suffer a loss for that. But in my understanding, some of those CDs don't carry that penalty. Some do, but I don't know specifics of that. I was just thinking from my own playing around in the markets. But anyway, what I would like to see overall, here's my goal. I want to see us, when we do our budgets, we forecast our return on our investment of not 1%, but 3%. And so that's my personal where I think we should be. And so that leaves a whole bunch of questions, not necessarily to you, but the financial advisors, but to the board, of what do we really want to do with this? And if others don't agree with my goal, then what is our goal? Are we happy with 1 or no percent? I don't know. And I was a little bit, this is kind of an odd thing, but I was a little surprised you said long-term was higher interest than short-term. What I've been seeing is just the opposite. Short-term is higher than long-term, but at least for CDs. I don't know about everything else.
That would be the case. The yield curve out to about 1 year is still inverted, being longer. The shorter you go tends to be higher than a 1 year investment. But when you start getting to the 1 year to the 10-year range, the yields get up higher. So it's consistent with what your statement was.
Okay. Well, anyway, Director Quillisi and Director Berg, what what, where do we go from here as far as, do we really want to have a policy of trying to, you know, get the most return on some portion of our portfolio? Or are we happy to continue as we are? And I don't, you know, I haven't talked to either one of you about that, so I don't know what your feelings are.
I'm still struggling with these concepts of yield to maturity on cost and on market. You could explain, because the numbers are obviously wildly different there.
What they're telling us different aspects of your investment. So the yield to maturity at cost represents their earnings rate of the securities based on their original purchase price. The yield to maturity at market indicates if I held all of those securities to maturity from this point in time, December 31st, what would I end up in total return? Because currently you've lost, market values have gone down, so a lot of these securities are at unrealized losses. Well, if you hold them to maturity, you recoup that unrealized loss, so your return over that time frame is higher. So that's what they're trying to represent. One was the original earning potential of those securities in the portfolio based on their original cost. The second one is what they would earn from December 31st to 2024 based on their current market value till final maturity, representing the recoup of unrealized losses in the portfolio. Did that provide an adequate answer to you?
Yes, thank you for that.
Certainly.
That tells me if we hang on to what we have, we'll be achieving that 4% mark.
On a total return basis, yes. Your accrual earnings from this point in time, because it ignores gains and losses, will continue to be about 1.12% on an accrual basis. On a total return basis, it'll be 4.52. So if you want to do something else with the securities, what we could do is sell securities now. We would realize a loss. The loss would depending on the maturity and everything else. And we could buy a new security, whether it was a 2-year treasury, a 1-year CD, those types of things, and lock in that higher yield for whatever the time frame was. So again, you know, it's on a total return basis, recapturing the unrealized loss, or just the accrual basis where it ignores gains and unrealized gains and losses. Their current earnings rate's at 1.12.
Okay.
So just to help me with what you just said, in my mind, the way I look at that is if I buy a CD today and it's got a 6-month term and it's going to get me, you know, or let's just say 1 year to make it easy. So it's got at 1 year, it's going to give me 5%. But if 3, 4, 5 months from now, interest rates go to 10%, then the value of that CD, if someone were to buy it from me at that time, would be less because they can get more money elsewhere.
That is a correct statement. If it's a security that can be traded in the market, you're exactly right. If interest rates go up, the value of, let's say it was $1 million when you originally bought it. If the interest rates go up significantly, it may only be worth $900,000. Again, it depends on the term and the actual interest rates, but the concept's the same. Interest rates go up, the market value of that security would be $900,000. But if you hold that security, that CD till maturity, you're going to get your $1 million.
I'll get my original 5% that I counted on when I bought the thing. Okay, so that's kind of, so my view of how that works is more or less right. So
correct.
And so that's why I think you're telling us if we have investments in our portfolio, easy for me to say, that we thought would return 4% over the life of them if we held them to maturity. And if we had to cash out early, we would take some loss, but that hopefully, presumably, would be offset by higher returns on whatever we put that money into. once we've taken it out of what we consider an underperforming asset.
Once we've taken the loss on the CDs or the bills or the bonds, then we can do better new ones. We will have also
Right.
taken.
And so it's just a question of what's the payout. You know, if you're going to be in a loss position for 2 weeks, 3 months, a year, you know, before you go back into the positive because you made that trade. You sold the low performing and bought higher performing. And so that's the kind of thing we'd have to work through, for our current portfolio versus what we could put it in, and just see, where that payout occurs. And that, you have to go through that.
Sorry.
Go ahead.
I suspect this would take a little bit of elbow grease to figure out.
Yes, it would.
Might be useful to us to understand, at least by maturity ranges, what those yield to maturity at market numbers are. There are some long-term ones that are really going to give us 4 or 5%. And like this year, I don't expect the weather is going to cause us floods like it did the last two. It's a dry year.
Right. Yeah, I don't think we're going to have
beyond a year. Then we have to start worrying again. But are there differentiations in those pieces of the portfolio where some could be sold and reinvested with a small loss, whereas others would be, if they were sold and reinvested, result in a large loss? Is there anything that you can comment along that line?
First item is, yes, your statement is exactly correct. The second aspect of that is, if I sell it, when am I investing it to? So if I'm just investing it for a month, the yield relationship will be one thing. If I invest it out for 5 years, just using long examples, it would have a different relationship, meaning I would have more time to make up that loss. So,
right.
Does that answer your question?
Oh, partially. I'm looking at pieces of the portfolio right now, and you grade different pieces of the portfolio as to what their, instead of what you've given us as an average for the entire portfolio at yield to maturity in 2 different ways. Are there, and clearly it's an average, but are there better performers and worse performers in the portfolio such that, just hypothetically, we could sell some of those that have not taken such a dip in value and reinvest those? Maybe those are already the higher yielding. Anyway, I don't know.
It's a very good question. And yes, we could do that sort of analysis. Some of it would be like on the chart we have up now in the maturity distribution, there's almost $2 million that will mature in the next 6 months. So on those, you may be better off to just hold to maturity and take no loss, recoup that. And then there's the bucket in the 4.7 that's 6 to 12 that you could go, okay, some of these I'll hold to maturity. Others I think I'd be better off selling. But the thing that would help us give a better idea of the benefit or the drawback to doing it is when you would need that money. If we sold it, so if we sell it tomorrow, how long can we invest that new cash?
Right. And so that
Short-term treasury bills are still running above 4%, I think.
Absolutely. But the question is,
Treasury
you're
Direct
only,
the other day.
yeah, the comment on there would be you're earning 4% for 1 month or 3 months, whatever the term is.
Agreed.
So it's,
well, we could go up to 9 and still get 4, I think, right now. But anyway, that's the whole point, is how long do you want to do that? How comfortable are you in feeling that you have some portion of your money that's, CDs are really pretty liquid over the period of a year, but not so, and so, what portion do we feel comfortable in focusing on high yield versus, having money in the piggy bank if something happens? And I don't have I would think at least half, but I don't, especially if it was in 1 year or less CDs. And then, beyond that, I don't, we're all trying to predict the future. Who knows
Sure.
what kind of disaster may befall us, but,
You're talking bank
and,
CDs,
and,
corporate?
and even the question
Treasury.
then is what, if we do buy a CD and we have to sell it early, what's the real penalty? Is it, 5,000 on 300,000, or is it, what kind of numbers would we really be looking at?
There's two aspects to that. If you're talking about a normal time CD going into the bank and giving them the item, generally, but I can't speak for all of it, a lot of times
Right.
the penalty is some percentage or all of the interest you would have earned. So typically
Right.
you would not have lost any principal, but you may not
Right.
have had any net return. If it's a negotiable CD, you pay whatever the current market price is. And if you're selling it early and interest rates have gone up, you could take a loss on principal.
Right. And so that I'm generally pretty conservative, so I would choose to go into one where my principal was protected, but I'd be willing to sacrifice the interest, just on playing that risk game that, I think I'm not going to need it for the next year, but maybe I do, I don't know. But
And
Well,
here,
what-
a question for
Go ahead.
staff. It shows our market value at 3 million. How much of that is fenced? That all usable for investments?
No, so your memo reserves, so your treatment plan replacement reserve, all of those reserves, some of that money is identified in this 8 million. So very small portion of it is discretionary. Most of it is fenced in those particular reserves. So it'd be essentially to make it truly good to use for whatever you so choose. By virtue of your financial structure, your reserve structure, fenced your money somewhat. And
That,
so,
deferred comp and stuff like that is all.
correct.
Yeah.
So you don't really have a lot of
Safety is paramount.
discretionary dollars. All your dollars are pretty much spoken for by either by adopting the budget or fencing it via your reserve. So what actually totals this amount is like a special kind of math, because I'd have to go through one and identify essentially where all of our money is to tell you exactly how much of each one of those reserves is likely in here.
Well, the last time we looked at, I guess it was the last monthly meeting, we had a balance sheet in there and all the reserve funds laid out. Seemed to me it was about 6 million out of the 8 plus was, I don't know what financial term for it is, but it's don't touch money.
It's probably a generally accurate.
Maybe one.
So in talking about don't touch money, it's not just sitting in a bank somewhere doing nothing. It's
No.
invested somewhere.
It's
Even though it's in a
invested in
reserve, right?
ultra safe as opposed to somewhat risky but better yield stuff.
Well, but I don't
So
know
it's
that
something that's
ultra.
important to understand is that when the board approves a major expenditure, they're approving the major expenditure to come out of the reserves, but where that actual liquid dollars comes from, come from here at a loss. I think that's something that's important to know, is that when you approve something,
Sure, it's not all just cash sitting.
so we try to fund as much as we can out of our actual cash flow, as we did
Right,
most of the
right.
TMDL. We didn't take an $8 million chunk out of here immediately when you approved the TMDL. We knew that we could cover it based on the pace in which they were going to be working and
We
invoicing.
authorized funds to be liquidated as the project went on.
That is correct. So what actually comes out of here is based on what he said, liquidity needs. It's exactly based on the pace in which we would make a payment and what's available at the time in which you approve.
But out of the 8.3 million or so, there's maybe 2 million, 3 million that we could play with if we wanted to look for higher yield.
I wouldn't necessarily say that until you pass your budget. Because your liquidity needs and where your budget lands will directly correlate with your expenses and your revenue and where your revenue is going to cover your expenses, and anything that doesn't out of structural funds presumably come from supplement.
Yeah, and that goes up and down. You don't want the waves in the swimming pool to expose the bottom of the pool.
Yeah, but the nice thing about a budget is you presumably know when most of those expenditures are going to occur. So if you were to invest in higher yield in short-term CDs, you could model that such that you never expose the bottom of the pool, so to speak. But the point then becomes, that becomes a big project to manage that to that level of detail. We're constantly selling things out of our portfolio to cover these expenses. So taking losses on an investment is not something that we never do. We do on occasion for various reasons. But
Sure.
and so that's where I'm going back to, I don't know that, managing our portfolio to that level of detail is really what these guys signed up to do. Because I could see somebody spending, all day, 3 days a week just trying to figure out what's the best shuffle. But if there were some general things we could do that, 20% of our portfolio we want in higher yield stuff, or, some general guidance like that, that may not require as much effort as a more, really trying to get the absolute most out of it. But again, it's kind of, it's the board's decision how we want to do this in
Sure.
general. And the details of it, we're not really qualified to, make the kind of decisions that our portfolio managers would be making.
That's their job.
And it may be that, it could get to the point where we're having to talk with them, once a month just to make sure we're on track, or, and I don't think any of us really want to go there. I think we'd like to have perhaps a little tighter rein on things than we have had, but not to the point where we get micromanaging this. So again, I don't know what you guys think. I mean, my general, again, philosophy is I'd like to see our returns, our interest come in every year on our budget, 3 times what it was projected last year. I'd like to see us have some percentage of our portfolio in higher yield stuff rather than all of it in safe. But I don't have an idea of what those percentages look like. And again, you guys may not agree with me. It may be that we're happy doing what we're doing. I mean, it's not bad. We're not losing money. And that's good to me.
Not losing is the first criterion, but
Right.
I presume that there is all of that, all the money that you have from us right now invested somewhere, correct? Not just sitting in cash.
No, all of that 8.3 million is invested in something. 7.594 million of it is in individual securities, whether they be U.S. Treasuries, federal agencies, those types of things. 722,000 is in called the Camp Pool. Camp Pool is invested in short-term Treasury bills, commercial paper, negotiable CDs, those types of things. So all of them are invested in something. The one comment I would make, just going back to some of the discussion, is what we don't feel comfortable right now is that we're doing the best we could be doing for you, that what we really need to do is, have a better idea of where you want to end up long term in terms of when you need money and those types of things. From that, we can give you a better recommendation, and we should be able to increase the yield of the portfolio from where it is now by doing that. So again, we think, we would like to do better for you, and we're not satisfied with where we're now, but we need to work as a team with you to say, okay, where do you want to go from this point? We understand the past is the past, but what can we do for you going forward that might better meet your needs?
We should do the budget first.
I think we're going to have to look at budget for the coming fiscal year starting July 1st. I know I look at the financial report every month. The expenses, with the exception of capital expenses, tend to be straight line. The capital wobbles here and there. We have, as we at the next budget, there are going to be things that are not just straight line. I mean, the TMDL is more or less behind us now. And my thought was we're going to spend the next year keeping up, putting money away into reserves where we can. But the exception of FEMA projects, let's call them, there's no major capital expenses I recall hearing about that would take us away from a straight line expense estimate. That about right?
I think there's some major expenses that we're probably going to have, but I think that they're probably prescribed in old CIP projects, and we've known about them, and we probably still know about them. So it's, I think there's
Finished projects?
perhaps unfinished. There's some pipelining that's still outstanding. There's a roofing project that down at the treatment plant, which is maybe a $500,000 to $600,000 for re-roofing down there. The screen.
You guys approved the price of the screen, which was about $300,000. We're anticipating construction costs to be around $1 million.
So.
Top of the
in listening
300.
to-
Construction portion. We just pre-purchased the screen because it's such a long lead item.
So I think it's easier to view it from the lens of the regular O&M budget is always should be fairly linear year from year. It should relatively correlate inflation and the cost of goods and services. It's very explainable.
Because the system and the plant aren't making drastic changes.
Well, and even then, like I said, it's something you maybe take the hit 1 year, but then that becomes your new normal going forward. Like, for example, you make operational changes and your chemical use goes up because that's your new normal. You're going to take that hit one time because essentially you're front loading it for that next year where you've implemented the changes. And then that's what's going to be your new normal going forward. So bring those little things, your O&M budget should be fairly consistent year to year and should be fairly explainable by what's going on in the general universe, right? That's why we bring to the board any major expenditures via those special requests, because that's the board acknowledging that those are your wild card items. Those are your items that are now going to start impacting your draws from PFM, or it's presuming that you don't have excess revenue to cover them, that you're not collecting quite a bit more than your O&M needs as far as tax roll is concerned and everything like that, which for us is not the case. We can presume that those are the things that are going to make your overall expenses, cumulative expenses, go like this. And how you choose to actually, how you spend that money depends on what it is that you're approving. For example, a $900,000 gap backs that got delivered in a 3-month period is a very large expense that you didn't get to spread out the invoicing over a period of time, such as a construction project that's going to take several months, or something to that effect, or ordering a screen 1 fiscal year and then doing the construction in the next fiscal year that may span over 2 fiscal years. very different thing than taking a $900,000 hit all at one time. That makes sense. Those are the things that go like this that are going to make that number kind of go like that.
The capital expenses,
Correct.
or I should say the one-time capital expenses, MDL gradual capital.
Correct.
expense.
That, we were very fortunate in that that one was like the best case scenario of such a large amount of money is that it spanned over such a large amount of time.
I think it would, I
So-
agree with you. It would be better if we could get more yield. Everything's invested right now, so there's not any free cash lying around. The camp
No, I don't
stand that
think
well.
there
It's not
is,
that
but-
much anyway, 700,000.
But I think what they
Maybe that's the
said is
ten
that
percent
there's,
we can play with. Oh, thinking.
well, I think what I heard is that there's some money that's invested now that those, some of those investments will reach maturity within the next few months. And when they do reach maturity, if we've not set that money aside for a, capital project of some sort, then that money's going to need to be reinvested in something.
Right?
And so if we could kind of identify what money that's invested now is going to come to maturity in the next 6 months, and then for that, we say the philosophy for that money, assuming we don't need it, is that we would like to, focus that money into higher returns, even if it's, a year or less, just on the thought that interest rates are going to be high for the next couple of years anyway, at least this year. So, in other words, focus on the money that's coming out of reaching maturity in the short term. And by short term, I mean 9 months or less, and have the investment.
You've got 0 to
counselors-
6 and 6 to 12 there.
Yeah, so there's the two categories. Stuff that's coming out in the next 0 to 6, put that into higher return if we can, and then, 6 from 12, 6 months from now is July, so we could certainly revisit this again in July or before July, maybe in June, and just say, we've got stuff coming out in a month. Let's make a plan and meet again to decide what we want to do with that. But I don't know, to me, that makes sense. If we've got stuff we know is coming out of, it's going to mature in the last 6 months, let's focus on that and get that doing a bit more for us if we can. Does that
Even
make
the-
sense? I
The
don't know.
12-month, it starts to overlap the next rainy season. So there's some of that 6 to 12 month stuff
Right.
should
But
be
again,
talkable.
maybe we'll need it, maybe we won't, who knows? But if it's coming out, if it's maturing in 12 months, and that just happens to coincide when we have a storm problem, then great. It's coming out when we needed it. Anyway, that's my thought now, just listening and thinking about all this, is that we should give them some guidance that we'd like to focus on the near term maturing portfolio assets and get those going for us a little bit better if we can.
Well, a question
That-
for staff again then. Over the next 6 months, now and the new budget, anticipate these substantial draws on PFM? Or are the ratepayers keeping up right now?
Scheduled disbursements out of PFM annually anyway that they know about. That's what actually that camp pool is that's money that they matures. They don't reinvest it if they know we're going to need it. And so some of that money has actually already been earmarked. But as far as 0 to 6, the 1.9, there is no anticipated need immediately for that 1.9 million. Barring any emergency.
So under normal circumstances, that 1.9 all be going into the camp pool?
they reinvest that. They would only, if only
Camp pool not invested?
it's invested in something in very short-term things, he said. And then, so that it becomes available based on when we've already told them the amount and date that we need it.
For
Right.
reference, Camp Pool is earning 4.52 as of the current yield.
That's
So
a
it
short
is,
yield.
it's a liquid yield, meaning if you told us you needed 100% of the money in the Camp Pool tomorrow, you could have 100% of it. But its current yield, current 7-day yield as of yesterday is 4.52. But it's right, it's a short-term yield. So if the
It's more
Fed
of
starts
that.
cutting interest rates, it'll go down, down, down.
Right. Yeah. Well, there may not be that much low-hanging fruit in our short-term maturing stuff. I guess what I'm wondering is switching the direction a little bit, what about the long term? Do we have stuff that was purchased with the idea that it was only going to return 1 or 2% over 5 years? Or
When we were buying those investments, the forecast for like a 4-year investment was under 1%. This was post-COVID and everything else. And the Fed's projections rates were very low. So they reflected the interest rates expectations at that time. Certainly did not reflect, But remember, go ahead, sorry.
No, you tell me. You're the teacher. I'm just asking dumb questions. So tell me what you're going to say.
One key thing is basically 80% of the existing amount in the portfolio, the 8.3, will mature in the next 12 months. So yes, you have another 2 million, not even quite that. 1.8 million after 12 months. So most of the portfolio will mature in the next 12 months. It's only a little bit that's going out. Go ahead.
So normally, under our current guidance, is that money would mature and you would look around for new investment places for it, other than that portion we think we might need. It's more short term. And under the current guidance, you would invest that with the idea of safety primarily, rather than highest return primarily.
Okay.
And so I guess what I'm wondering is if the stuff's maturing in 12 months, can we switch that ratio a bit so that some portion of it is focused on higher return and some of it's more safety oriented? I mean, we don't want anything that's high risk, but
The law
does
doesn't
that make
allow
more
us to
sense?
buy anything that's not safe.
No, yeah, no, I realize.
Play or better.
Again, I'm just trying to figure out a way, how do we get more than 100,000 a year coming in on interest so that we don't have to raise rates to our ratepayers? And if we can get another 100, 200,000 a year out of our portfolio, that's what I would like to do, because that's equivalent to a 2.5% rate increase on our ratepayers. So roughly. So anyway, and maybe at the end of this discussion, or maybe the outcome should be if you guys could look at that and just see if you've said you want to do better for us.
Correct.
If there's some recommendation that you could make that says, here's what we think we would recommend to do better. Because we're not the professionals. We don't have a clue in hell what we're talking about most of the time. So if there's something that you guys could come forward to us with and just say, here's, knowing that what the general idea is, here's what we would suggest. Some of that may involve the 0 to 6 month maturing stuff. Some of it may involve the stuff, that's coming out 12 months from now. And just present to us, here's what we think we'd like to do, which might be just a change in philosophy. It may be specific investments. I don't know what it would look like, but does that make sense? I mean,
that makes sense. The only comment, follow-up from that would be, how much would you want to maintain in I can get this tomorrow type of cash versus, hey, I may not need this for
Right.
6 months or 2 years.
Right.
Sort of knowing that that division can give us a good direction.
Right.
So,
Okay.
yeah,
Well,
that's really a staff question. So looking at the 0 to 6 months, 1.9 million. I think what I heard you say before was we don't anticipate needing that cash absent something pathological like another storm. So maybe we start with that, Lowell, and
yeah,
see if the board
you
would
know,
agree to
or at least,
start reinvesting that 1.9 million higher yield stuff.
yeah. Well, you know, that to me makes sense. The other thing that I'm realizing as we talk is that 2 years ago, we were putting in money in instruments that the best you could get was around 2%. You know, and now practically everything you put money in is going to get closer to 4%.
Right,
So,
but if you try to sell 2% stuff or 1%.
yeah, no, I wouldn't. Yeah, I'm
You're
not.
giving up principal reinvest.
Yeah, I'm not really in favor of selling things at a loss unless it has a very short term, and by that I mean, you know, 3-month payout with the loss. And I don't think things that are going to mature within 6 months can give you that kind of payout. So I wouldn't be in favor of selling, you know, assets that are going to mature within 6 months, trying to get a little bit better interest rate. I just don't think there's a payout there.
I would agree. Randy?
1.9 million. That's perfect.
Let's start with that pot.
Richard coming back, some sort of,
The
something with
next,
a bow to bring to.
next is 4 point something.
4.7.
Okay. We could start looking at that and maybe talk about this again in 6 months.
Well, this particular is a committee, so it's advisory only. So if you're changing your investment strategy, it has to go to the full board.
Right.
So I don't know if Richard wants to come back and do a presentation on potentially changing investment strategy and sort of using this as the preface for that. That's up to you guys, but the full board has to.
Yeah. I'm talking about what we now recommend to the full. Let's use the up to 6 month money. Some higher yields in that.
Yeah.
What is it, 4.7? Don't know. I presume some of that, these old investments that were at 1 or 2%, because that was the market at the time.
All of it would be investments that are at lower yields. So some of them maybe, I have to look at it in more detail, but some might have yields of 0.5%, some have yields 1.5%. None of them will have yields, I think, more than 2%, would be my impression.
Yeah.
That's
If there's,
in the
if there's
4.7.
stuff that,
Of the 4.7, exactly. To the best of my knowledge, I haven't done a detailed analysis of it. Just to give one quarter comment on that, on the 1.9, if we invested the 1.9 at 4% and had it for a year, your earnings would be $76,000. So whatever we do with any of those investments will be better than where we've been.
right.
In the
And I think because
4.7, I wouldn't even be in favor of liquidating anything in the 4.7. Take it out to maturity and we'll get more like the 4% than the 1%.
Yeah, my thinking on the 4.7, if there's stuff in there that's earning 0.5% or 1%, I'd look at that real hard as to being willing to sell it and put it into something more. Because I think there may be payout there.
There may be, although if the base rate on it is 0.5% or 1%, or even 2%, selling it right now means you're eating principal. I would bet.
Oh, no, I understand that. But again, if there's a payout to doing that, which I think there might be, in the 12-month plus range, but then I would just want to know what the numbers really look like.
Would be worth looking at, I guess. Yeah.
Yeah, I'd
Months-
certainly be
months,
willing to
There's
get rid
almost
of some.
nothing out there, right?
Yeah. On the face of it, I'd be happy to dump anything at 0.5%, but I would want to know what the penalty is and when I'm going to recoup that loss.
And
And
that's
I'm-
something, I'm sorry, go ahead, Robert.
Oh no, I was just gonna add, I'm sure that me and you, Richard, can go ahead or I can go ahead and find out when what is maturing, how much, and also speak with the portfolio manager to kind of get a recommendation. My sense is that we would send something to you saying, hey, this is, for example, the 1.9, this is what's coming due. Here's the recommendation, and kind of get your thoughts behind it before doing anything in that sense.
Even the 4.7, there's a lot more there to be done. Yeah, if we had a little more granularity, these numbers rather than folio averages, we might have a better idea of how much loss we could stand in reinvestment.
Yeah.
Richard, were you gonna say something? Sorry, cut you off.
No, I would agree with the statement that was just made. The only key question of that is there money that you need to make sure that's maintained liquid and which can be invested out longer? Because if I sell something, take a loss, but I can only invest it overnight, that has a different calculation that yes, I can sell it, take a loss, but I can re-earn it over 2 years.
Right. Yeah, so we still have some homework on the board side with staff to figure out what that number looks like. Do we think we can set 6 million aside to do this, or can we only set 1 million aside to do it? And that's a number that you need to have to really kind of define your marching orders, I guess is what I would say. But
I would agree with that. I think defining a direction, and I'm surprised, Richard, you haven't said this in this meeting, but I know we said it before with other clients. It's, we can get you to a destination if you provide exactly where you want to head to. For example, we can get you to Santa Monica if that's where you want to head to. But if, the direction is to go to Malibu and we're heading towards Santa Monica, we're not going to get anywhere clear. So that's the part of it. And then the other part of it is, if something happens on the way there, that's the thing that we want to anticipate, as fiduciaries. That's always top of mind, is keeping that safety first and making sure that we don't put you in a position or things aren't thought of before where something comes up and it's, well, we didn't anticipate that and then it's at a loss, and that's a bigger issue. But not saying that would happen, but
no, I know what you're saying. And I think the good news in all of this is, while 2 years ago, the best we could invest in might've been 2%, right now, if we do nothing and just do your normal course of investments, we're probably going to get close to 4% anyway. Right? Just because that's where the rates are right now.
Yeah.
And
That's
so,
correct.
I think if we'd done this a year ago, we might have actually got some significant results. But as it is now, we almost can't help ourselves and still get, closer to 4% than 2%. So I think we're in a good position to be able to do this stuff without really a huge amount of loss. Because when we say we want to maximize investment right now, I don't think any of us have the feeling that we're going to go out and find a 10% return anywhere. It's just not going to happen unless it's very high risk.
It's out there, but the law won't let us invest in it.
Right. And so, I think, again, we're really in kind of a good position, in that, as toward my goal of getting more than 100,000 a year in return on our portfolio, we should be able to do that almost without trying, just because of what's available right now. That may be wishful thinking.
Maybe what this committee can do then is recommend to the board at least starting with the out to 6 month investments that we have, that we ask PFM prioritize yield.
Yeah. Yeah.
Over liquidity.
Okay, well, it sounds like the finance committee needs to spend some more noodle time on just exactly what guidance we would give PFM and how much money is involved and over what, the questions he was asking. How much of it can I count on being able to invest for longer term versus how much are you going to need short term? So, and
Another
because
question is-
stuff is maturing in 6 months, we've got a little bit of time to meet together and come up with that.
some of it might be
I'll
next
call it.
month, but you're right. Yes.
Yeah.
Another
we-
question.
we can-
Staff. Don't anticipate needing that 1.9 million operations. Could be able to handle operations with our current income.
Depends. I'll have to look and see what's actually in the pool. That's actually, I think it's less than that right now. See how much of the planned disbursements that covers. So the answer is, we'll have to look a little.
Some of the pool may be in that 1.9.
No. I don't think so.
Pool is all money market or something like it.
Yeah, the pool is short term, so that makes it easily available for
Right.
disbursements, but we have pre-planned disbursements. So I will have to calculate sort of how many months that takes me out based on what I have planned, based on the balance. And then I don't know that it's quite so literal. For example, something could be coming to maturity in the next 30 days and probably put it in the pool. And so maybe it won't be exactly 1.9 that becomes available for you all to reinvest, but something of business, I think we can make it work. I'd have to look at it a little closer because our bond payment coming up and everything, I have to see what our balance is at the county and sort of really evaluate our cash flow we have coming up. And what will happen is once we sort of make that determination, those become limitations as to essentially what we go forward with that goes over and above being calculated. So we'll have to consider any projects we have coming up as well, because those would not be covered by any of the current cash
And
flow.
I don't remember the numbers from the last report. What sort of money do we have with the county and what are we making there?
Well, the unfortunate thing with the county is that liquidity needs are such that the company does not sit there a very long time at all to really earn hardly any interest back. We spend it very, very quickly because that's what feeds our entire cash flow. And then traditionally,
County is tax roll, you mean?
correct. And so it sits in a fund, and the longer it sits there, the more it gets. But like I said, request disbursements to feed our cash flow so frequently that the return is very nominal because nothing sits there for very long.
Right.
Traditionally, you can probably remember when we transitioned to PFM, it would be right before each of the next disbursements in the tax roll, we would evaluate the cash flow and take anything excess and send it to PFM for reinvestment. But we're so close to being dollar for dollar now that we don't have that ability. And that's why this investment strategy has sort of changed so significantly. There were years where we sent them $2+ million of excess funds to reinvest. So one time. So that's the enormous difference that we're not sending them anything to reinvest.
But the county money really comes in twice a year. So that's what, November and February or some sense?
Yeah, for us, it's December and last year was May, but yeah, they were pretty late.
So we can't count on county. The county money really keeps.
Like it's a
That's
revolving.
O&M. Yeah. Okay. All right. Well, I would suggest what we recommend to the board, looking at initially 6 months less term current investments for reinvestment, then 6 months from now, that'll all be in, that next batch is 3 times the size almost. 2.5 times. Then that's some more short-term stuff to look at. And we can ask some questions of him at that point, say August or so.
Yeah. Yeah,
All right.
I'm okay with it. I think there's a lot of things we all need to learn. But I think, we've got professionals doing what they're doing. They probably have a pretty good idea of how they could adjust their strategy a little bit to maximize, the returns. And if we can help them in some way over the next month or so, then that would be a good thing.
All
So
right, that sounds good.
I don't know that there's anything we necessarily need to report to the whole board at this point until we've come up with what it is we really, what we're suggesting, the guidelines for.
It's going to take us a good chunk of that 6 months just to figure out the need. The 6 to 12
Well, it'll
months.
take, I mean, if we really worked at it, I mean, we could do it in a couple of weeks, but we don't work that fast. So anyway, but Director Quilty, I'm along with whatever you want to do at this point. So
Yeah, let's just say would recommend to the board that 0 to 6 month stuff looked at as candidates, investment, more of an emphasis on growth, on liquidity.
and then hopefully by the time we approach the board with that, we'll have a better idea of what the actual numbers are. How much of the 1.9 we really think we can do that with. That'd be good.
Very good. Richard and Robert, thank you very much.
Thank you for your time.
Thank you.
Yeah, you were very instructive. I enjoyed the discussion. Good.
We really appreciate the questions. We always recognize that ultimately you're the custodians of these funds, and we want to make sure that we're acting in accordance with what you are trying to achieve, and we're making sure we're providing the information you need to make informed decisions. So again, thank you for your time tonight.
Oh, well, thank you.
Yeah.
Thank you.
Robert, thanks, Richard.
Au revoir.
Item 4, presentation from General Manager on inflation.
All right, yeah, so what I have here is,
Writing.
yeah, the intent of this is to the intent is not scare anybody, but to help everyone understand that inflation is inevitable. And I think come one way or another, it's going to come and it's going to be something real that we have to address. That's the intent, right? And so if you go through here, you can see that there was 1996 ad in Time magazine from the Teachers Insurance and Annuity Association, saying in 30 years, a burger and fry is going to be $16, a vacation is going to be $12,500, and basic car $65,000.
My wife has a
They missed
TIA
on-
CREF account.
Okay.
15 years of school teaching.
Right.
They missed on the car, but they got everything else right.
Yeah, they did. You're exactly right. Well, we're not there yet. They said in 30 years, and that was in 96. So we still have 20 months,
Oh,
right?
okay.
Yeah.
Still got
So
some
be
time.
careful what we wish for, right?
Yeah, right, exactly.
Yeah. Bottom line is it's yeah, like you said, the car is not there yet, but certainly the vacation and the burger is. Two different ways that the district has historically looked at inflation. We have consumer price index. As Allison mentioned earlier, the consumer price index really kind of affects our O&M, whether it's cost of labor, cost of electricity, things like that. It tends to follow that consumer price index pretty closely. The feds have mapped that out from 1913. The other thing that we do look at is it's the engineering news report, and it's called the construction cost index that for the LA region. It's very specific to the LA region. They actually have two indexes. They have the building construction index and the construction cost index. They are different indexes. Our code actually references the construction cost index a couple times in it. The difference being is construction cost index has a higher value on labor, less than skilled labor, and it has some different materials that come into it, right? So it's more steel, concrete, rebar, stuff like that, less high end, less wood for the building construction index.
PCI is more residential construction.
Yeah, more residential construction. So you'll have timber in there and stuff like that. So kind of slide through this presentation. What you'll see, the first presentation has 1913 till now, the construction cost index and the consumer price index, and construction costs has outran it about 2.5 to 1. If you flip over to the next one, it's a log chart. The log chart takes out the compounded interest, right? So it turns into a straight line, but it's more of the same. Next chart is 1963 to present. Why that's kind of important for us is a lot of the infrastructure that we have came into existence in 1963. That's exactly right. In this, it's notice that the construction cost index outpaces the PCI, sorry, the CPI. Flip over to the next one, you get 1985. 1985 was chosen because that's when the district was formalized, right? So in 1985, the district absorbed parts of Miners Oaks. That was some of the stuff, the structure that was constructed in 63. On here, you have the annual the basis rate. That is, and if you also look at it, the in 1985, the monthly fees was $8.50. So if you do the math on that, it comes out to $102 a month, which is really darn close to the 100 that I've been using as the baseline. So this particular one, I just kind of ratcheted everything up from 100 for the CPI and the CCI to 102. And it can just show you how the rates have matched, exceeded both of those. I think the important thing to note is
The green line is
rates.
service charge per month.
Service charge per, well, it's on an annual basis to get it to match 850, but yes, it's service charges. Next chart, if you go over that, it's the same thing, but it's in a log format. So again, it takes away any of the continuous compounding that you would have, turns into a straight line. And the last one is 1996. What's interesting in 1990, well, if you go back to the 1985, so 1985, the consumer price indexes exceeded from 85 to present. Consumer price index really ran strong in the middle of that, but from 1996 to present, the construction cost index ran strong. So I just want everyone to kind of get their head around it, right? It's going to come, inflation. I don't know that anyone, Richard, Robert, I certainly can't tell you whether that inflation is going to be 1% or 4%. But if we look back and look at history, it's never been negative. 1963, right? So you're going to have some inflation, and in the long term, it kind of works out to the place where advertisement 1996, they kind of nail it in Time magazine. It's my point is whether it's 1% or 7% like we had during COVID, all kind of comes out in the wash if you pick whether it's 2.3, 2.4, 2, 3, whatever that number is, it's going to come out. But to think that you're not going to have any inflation for multiple years in a row is not going to happen.
I'm looking at is, so I'm on the 1985 to present CPI and growth in number of residential and commercial accounts over that 40 years, guessing is pretty small. And so the
Yes.
costs of operating the district are going up a lot faster than the number of people that are paying for it.
Yes.
So I would expect the basic service charge to be going up, maybe not a factor of 7.
Yeah, that part is true.
We aren't growing it. We aren't growing enough pay for what we're doing.
Correct. Yeah, we are not growing enough. And then one could even argue that, I mean, if you look at flow rates, frankly, we're coming down. Right, with dairy farmers,
There's that,
Right.
yeah.
I mean, it's. So that's where this whole presentation was, is just to help people understand that, listen, it's embedded in there. I don't know that we can guess it year to year, but I think if you don't get it one year, it's coming the next. Any other questions on that one?
Well, the inflation is where it is. Okay, the next item was a collection system capital improvement program.
Yes, so we have a very detailed collection CIP for the treatment plant. We had a relatively detailed one in 2007. It's had its time, its place is my gut feeling. If you go to the second, the bottom line is, I think we're probably at the time and place to do a collection system CIP. What I would like to have someone take a look at would be the condition of the pipes, the condition of the manholes, the dates that these were constructed, the materials that they were constructed from, get an expert opinion of how long some of this infrastructure can last and will last into the future, and then give some recommendation on anything that we should be doing so we could get this infrastructure to last. Perpetuity is a long time, but last up until the next time. I've looked into it. It's going to be about $140,000 to $180,000 report. It's not a cheap report to have done.
Not have the data in-house already as to age of each part of the collection system.
We do have that data. We have
What's been lined.
We have that. Yep. We have what's been lined. We have the data of install. We have the material of install. We have some of there's a scale from 1 to 5 that we grade some of the infrastructure with when we either camera it or if they look down into a manhole. We have some of that. But what this report would be doing is to looking at all that, aggregating it, and coming back with recommendations of what should be improved or maintained or replaced and in what order.
Prioritizing updates to the system,
Yes,
retrofit or whatever you want to call it.
correct.
When we do this lining, I remember from the Burnham Road project, that we were told that the lining now becomes pipe. Is that true of all the lining that we're doing? I remember even when I first came on the board 6 years ago, talking to the crews that were lining the pipe along Kenyatta in the city of Ojai. But I don't know if that was the same stuff or not. Is that the same situation where lining now becomes the pipe?
The as-built, like the total depth, flow pressure, assume groundwater will surface, so max, and then they have to size the thickness of the liner accordingly such that it's a structurally sound pipe. You assume full deterioration of the hose pipe, new liner would be able to withstand pressures.
So the lining may be different thickness place to place
It'll be thicker on
based on your estimate of the pressure.
by 8 millimeter, 2 millimeters.
Well, I'm thinking, I remember when we went out to see the reconfiguration of the pipe down Creek Road. Trench was 25 to 30 feet deep. There'll be a lot more pressure there. Yada, I would guess, was maybe 10 feet down.
Less than 6.
less than 10. So all right. And that all goes into estimates for all repairs. What is the entity that would take all of the data that we currently have, decide should do next? Or I recognize $140,000 or $150,000. It's a lot of money. It's small change compared to district's budget. Still a lot of money. I'm just, I don't have a good feel for what we get for that. We already know the condition of the system in a fair amount of detail, I think.
I think we know it. I think we know it fairly well. But I don't know that. I don't know that. I haven't been able to figure out which ones I would necessarily replace and which ones I wouldn't replace by looking at it. My understanding when I talk to the civil engineers that perform this type of stuff consulting wise is they have a matrix, they look at it, they have an expectation on certain age clay pipes with certain installations, looking at the conditions, and they have a fairly, I don't know if I would say predictable, but at least they have a basis of putting out this information and giving recommendations on why they think it would be prudent to replace that at this given time. Or the reciprocal of that is, hey, listen, you're probably getting another 15 to 20 years out of this thing without ever taking a look at it. That's the other question. If you go over to the table I have on table 1 for the same thing, the same topic. My concern is talking about inflation is in 1965, the Miners Oaks Sanitary District was $1.8 million then, $1.7 million then. If you do the CCI on that, it's got a current value of $21.6 million. What I don't want to do is get $21.6 million of infrastructure wrong and be behind the curve on that. That's my concern.
Miners Oaks, that includes the city of Ojai, I think. They were consolidated just before this.
Yeah. And then, there's the trunk line, the trunk line, again, $6.7 million would be the current value of that trunk line, the Miners Oaks, or the 63 trunk line. I mean, these are the biggest line items from our accounting system. So there's 8 line items in here. The total, just under $64 million worth of infrastructure. It's in today's day and age. I don't want it to get away from us is where I'm going. If it's
So
I do that $150,000 is a lot of money.
Here's my thought on all this, if I may. I think, along with Director Quillisi, that we have a pretty good idea of what our system's shape is in, where the problems are, and I'm fairly confident that if our in-house engineer and our in-house engineering tech spent a day or two on this, that we could get within 20 or 30% of the answer that these consultants are going to get for us. And if we're only concerned about cost, that entirely depends on when we actually do it. And again, I think given the inflation numbers we've seen, how consistent they are, we can guess pretty well at that also. And so what I've seen happen in the district is we have an engineering project come up. And so we have a choice of how to approach that. We can go out and have an engineering firm do a scoping study, which is what this looks like to me. And then we identify these projects. And then when we get down to actually doing the project, we go out and hire consultants again to actually do the detail work necessary to complete the project because our in-house staff doesn't have the time, for one thing, and maybe not the expertise to really do the detailed design work. And so I'm not in favor of spending this money. I would rather save it and spend it on the engineering consultants that actually do the detail work and let our in-house engineers do the scoping studies, knowing that, you know, they're not perhaps going to be quite as accurate as spending 150,000 would get us, but they're not going to be, you know, very far off. And by that, I mean 20–30%. And so, you know, to me, the bigger issues, where are the problems? And spending, you know, an engineering consultant's going to have to go out to really know that. They're going to have to do line inspections and all that kind of stuff. And I truthfully would rather spend our money on doing those type of inspections rather than hiring a consultant to tell us we need to do those type of inspections. So I understand what you're saying, and I just am not in favor of approaching it this way.
There's another factor that hasn't been mentioned here, and that's the I&I, which varies from place to place in the system. But I think with all of the measuring devices that we have in the system, we have a pretty good idea of where those problems are. That would tend to prioritize our lining anyway, I think.
You need to restore
Well,
Y&I areas just because it's a high PACP score, like he mentioned. The post pipe structural integrity is
Yeah,
concerned.
yeah. The I&I is one more factor along with condition of the host pipe.
That study from how we've targeted, we've moved through our system with these large scale I&I projects, participation of our new effluent.
You think you have a good idea right now of what we need to do, or you giving some guidance to the engineering tech, finding a bunch of numbers?
Target areas, and since I've worked here, the collection system has tried to do all that we can with the funds that we're given. It's typically around $1 million a year. And we make the most of it. For example, with the project, did it in multi-phases so that if we needed to throw out a portion of it, we couldn't afford it. You know, if the bids came in high and we needed to do this portion near the siphon because it truly was falling apart and we were worried about it lasting another 6 months, we could get that done. We ended up getting a good price, so we were able to go all the way to the Chaparral and do the majority of it. You know, so we try to be creative and strategic as we bid projects. Mostly with consultants, we do the straightforward, I'll say, less engineering, more programmed I&I projects designed in-house now. Doing QC by outside consultants to save money. And there are some more sophisticated projects.
That's in the upgrading stages.
Yeah.
Not the deciding what to upgrade.
But we've decided what to upgrade. Engineering has worked with collections to determine target areas. Also, years to evaluate where I&I is coming from.
Right.
We're evaluating that. That's ongoing. We only have a target area. Concern is too is misinterpreting what Scott's saying, but what I'm seeing is we have all this asset value that's hit its life expectancy on paper. I think the question might be, is $1 million enough? Get ahead of it. It's all installed in the 60s. One question.
House is from 1930.
That's not great.
I have on my property 130 feet of ABS.
And also, we've done two primary lift stations have been upgraded. It's 20 years. We did Orchard in 2007, 8, 9, 10. Did Santa Ana station, our largest lift station in 2015. So it's been 10 years, and then both of those force mains are now welded HDPE. That's great. And then our two other lift stations, we do have anticipated repairs of those that will eventually be designed by an outside consultant because they disciplines and land acquisition and other things. We also have some, you can't get as much for your dollar as you used to, and we have some loop projects in the collection system that require more than that $1 million per year to siphons along Creek Road, the big one, and some other things. We have a lot of lines and easements. There's a lot of preparatory work, potentially environmental work. So I think kind of planning for that is something that Scott was hoping to. The
You see that as part of this $140,000 to $180,000?
The,
Or is that more of a system evaluation?
I don't see it in a look-see at the environmental side and ancillary stuff like that as being part of this 150. I think that would be separate. My expectation from this evaluation would be a recommendation of kind of what should be done in the next 5 years, an estimated cost and engineer's probable cost, so what that would be. And then looking out in years, 5 through 10, 10 through 20 of next projects down the line and what those costs are.
In this report,
Yeah,
that
again,
you're suggesting would prioritize different parts of our action system so that we can go in order
Yes.
with our funds.
And we do not have that sort of a plan right now.
We kind of have a plan. I think our plan that we have right now is we've looked at a budget of a certain amount of money and what can we do with that budget to stick with the plan. My expectation is this report would zoom out a little bit and say, you have this infrastructure. This is what you need to do. This is what their recommendation would be to do for the next 20 years to keep this thing running through perpetuity. And here would be the cost. That's what I'm expecting from this plan.
I don't see any value in that, to be perfectly honest. I think, we had a study like this done 2007. We've done our projects, we've kept things going, we haven't needed to revisit that. And I would, again, rather spend the money on actually doing something, hiring consultants that are actually doing detailed design for us rather than putting together 20-year budgets. I just don't see any real value in that. So, and just listening now, it seems like we have a pretty good idea what needs to be done. We have a pretty good idea what cost is going to be. And, I don't think we're out wandering around in the wilderness, wondering where we are or what planet we're on. I think we've got a very good idea of what needs to be done, when it needs to be done, and a pretty good idea of how much it's going to cost. And if it takes Liz or somebody or the new tech, a day or two to summarize that, put it all in together with the knowledge that we have, and then if at the end of that, we identify some huge gaps in what we know or think we know, then at that point, I might be willing to entertain the idea of going out and hiring a consultant to do it. But right now, I just don't see it as a need.
I would tend to agree. I suspect we know in-house, general terms at least, what needs to be done and when, and may not know whether $1 million a year or $2 million actually accomplish that. That might take some outside help, or that may be something we can do in-house. I don't know.
Or if we miss it by 20 or 30%, I mean, it's just until we actually get to the point where we're doing the detailed design work, their guess is as good as our guess, is what I'm saying. And why pay them $150,000 for a guess?
we definitely will need to pay for outside help to do the detailed design, environmental and all the rest. I haven't heard yet that we don't have at least a general idea direction we need to go, how fast.
Yeah.
If we had a more detailed answer of that sort, then we might I don't know that we couldn't derive that detailed answer with the resources that we have in-house right now. No, what do you think, Liz? Could you do that? Not looking for a 5-year projection of the cost of a foot of pipe or anything.
We have a spreadsheet that shows the age of the pipe, the material of the pipe, and the PACP score for everything that have been able to PO since we lost those records in 2020, which is about 70% of our system. So,
Lost those records?
yeah,
Oh,
we have scores for 70% of our system. So,
Well, I'd spend the money getting the other 30%.
that'll be done by our in-house crew.
well, that I think is the data that we need to evaluate in-house. How much more help do we need before we get to detailed design?
Yeah,
That's at least what I would recommend to the board.
maybe we spend some time assessing what is the priority in-house. Then get to a point where we have to hire a consultant beyond general prioritizing. That's where we should make.
We definitely need someone when we get to the detailed design of any particular piece of the work. We agree completely. I suspect we can do, if you want to call it a strategic plan, suspect we can do that with reasonable accuracy in-house.
Yeah, especially when you're talking
If we
about
get
20
to
years
6
out.
months or a year from now and don't feel as confident, I'd like to feel, as I do right now, that we could revisit this question and see if we need outside help in a general. Sounds good?
Yeah. This
Wow.
reminds me for all,
Go ahead,
this
please.
reminds me, it reminds me for all the world of something that happened in my career. You know, somebody had, my son calls him the good idea fairy, come around and decide that we were going to spend hundreds, in this case, it was really a lot more than this, on consultants to do a study for us that many of us in the engineering group didn't think we needed in the first place. But me and another guy got the bright idea that, gosh, we'll work weekends and nights and charge you 1/3 the cost and get a better answer. But, you know, just work anyway. That didn't go anywhere either. So, but we ended up not doing this study. But I just think we've got a wealth of knowledge in-house. And I think we've got a wealth of capability and competence. And, you know, let's use that. We're not in a big hurry to do this. So let's, you know, focus a little bit of time each month on putting this, you know, what we know together and coming up with an idea of
We have
where
a
that's going
feel
to
of
lead us.
it's going to
and
cost to
just summarize
reconstruct the data for 30% of the system.
And just summarize that in 5 or 6 months. And I think we'll be money ahead and you know, and if it, in doing that, our in-house, you know, determines places where we're missing data or surveys or wall thickness measurements, whatever it is, we can spend this money that we would have spent on consultants to go get that data. You know, anyway, I've said my piece. Sorry, I'll shut up.
Yep. I think we're in agreement. Right. Next is the vehicle replacement policy.
Yes, the vehicle replacement policy. So I came aboard, I had the opportunity to watch the purchase of a $750,000 GATVAX. And
First sentence is, yes, we need one.
yeah, and that was a lot of money. And I'm like, wow. And then my next sentence, at least that went through my head, was like, I was thinking that we must have known that we probably would have needed this a dozen years ago or so, because they don't last forever. And so where I'm going with the whole conversation here is what I have is a discussion that I'd like to bring forward with kind of having some plan of perpetual vehicle reserve and plan for the district. That's what we got going on here. So the background is that if you go look at both US and Canadian, for some reason, the Canadians really get into it. Light passenger.
Your weather.
It's harsher weather. I think that's right. It's harsher weather. And the reality is if they break down, they may freeze to death, right? Like between Saskatchewan and anywhere else.
And all the salt on the road.
Right. So the bottom line is life cycle for light passenger vehicles is kind of 9 to 12 years and 220,000 miles. That's really what it boils down to. After either of those, it actually starts to cost you money to operate it. But the reality is it's industry practice that most light fleet vehicles run in the 9 to 10 year range and 100 to 150,000 miles.
Sounds like home.
Yeah, the reason being is they start to become archaic. You all of a sudden you don't have a backup camera, and everyone else is accustomed to backup cameras. You don't maybe not have it. Now everything has anti-lock brakes, but that wasn't the case in the mid 90s, right? So there's kind of slurry issues that start to pop up on age. The OVSD, what we've historically used here, we have non-pickup fleets that we run. About 14,000 miles a year. The 5 pickup trucks, they run around 9,000 miles a year. And our heavy equipment, I've calculated it as a mileage equivalent. So the mileage equivalent is hours, because we have hour meters on a lot of our heavy equipment because it sits there at idle, whether it's the gap vacs, whether it's the camera truck, because we use the motors to run the heavy equipment. So those run around 20,000 equivalent miles per year. But they're diesel and they're kind of meant to do that. So
That's what we're really counting the age on the engine,
yes,
the entire vehicle.
not the entire vehicle, right? And then the one thing that has come up is there is going to be a need for a light duty pickup truck for the environmental compliance inspector when they come up. That's something that the first couple of weeks they get here, they'll be riding shotgun with folks. But when they're going to be able to go out and work on their own, they're not going to have a vehicle in our current state to do that. So we're in the place right now where we need to probably be a vehicle, or getting a vehicle for them to be able to go out and do their job.
We already disposed of Jeff's.
No, we have not. Jeff's
Would not be the environmental inspector's vehicle. Or
probably
is it nearing end of life?
it's nearing end of life. Yeah, we could go and I do have the details on it. So Jeff's vehicle, I always forget which one is Ford. It's 186, at least it was 186,000 miles on it, and it was a 2014. So that it's at 12 miles and high mileage. The other one that we have is the Ford Explorer. That's also a 2014, has 130,000, 129,000 miles, at least when I did this report a couple months ago. So Jeff's, it could be used in a pinch. I think that the inspector is probably going to have some dirty equipment, whether he's doing, we call it a sludge judge, which is a gizmo that they go out and they can dip grease interceptors with to see how much solids are in there. I think my point is you're going to want a pickup truck, not a SUV. If you're the inspector, you want to have a little bit of pickup truck so you're not sitting with the stinky stuff. In any event, so I think my point is I think we're going to need an inspector vehicle, and
Is that a F-10 pickup you're talking about?
no, I think you can get away with either a Maverick or a Ranger. It just the Ford Maverick or the Ford Ranger. It's just they're small, $38,000 vehicles. I don't think it needs to be all-wheel drive necessarily. It's the problem is
I don't live in that sort of territory here.
no, we have a couple four-wheel drives. We have a couple four-wheel drive vehicles. They do get used when they get used, but it's the exception, right? It's a couple days. Whenever the emergency is, if they need to go out on Creek Road, if Creek Road's flooded, yes. If they need to get down to the bicycle trail because there was a washout down there, yes. A couple times every couple of years.
The rest of us running around on paved streets.
There's some, I mean, there's some driving down some grassy easements and stuff like that, but I don't think we need a four-wheel drive vehicle for that. The other one is the opportunity that the Honda that you guys allowed me to drive, that's come back into the fleet. My contract provides for my own. So there's another vehicle that is now in the fleet at this point. So that, and what's happening now is Bradshaw is driving that van, trying to put some more mileage on that van. And we've parked the Just vehicle, and it's been made available for admin staff up here. It's that's the other thing is one of the things I would like to try to is philosophically, I think that a vehicle should wear out on mileage and time at about the same period. When I saw the Honda Odyssey that had 53,000 miles on it, and it was 2010, I could have been driven more. Right? That's try to get them to wear out. I'm not saying drive them to nowhere, but when one has 186,000 miles on it and one has 53, you probably could have shaken it up earlier. So anyhow, the other thing that does come up is the swap loader. So there's a swap loader that the collection both crews use. It's parked up here. It's not an ideal.
See that name on here. What is a swap loader?
Oh, it's also called the Freightliner, I think, in the tables.
Crane truck.
Crane truck, yeah, crane truck. Yep, exactly. And so the swap loader was purchased. I think it was a very expensive piece of equipment. It's not well utilized.
There was a trend for a while. This is before you.
Yeah.
Whatever was hired, this was something of a higher, maybe two-wheel drive to four-wheel drive. Ton to, in this case, what was the one that was retired with the crane on it?
Probably a 550.
550, okay. And much more, Freightliner's huge.
Yeah, that's the report that I get from the crews in the field. Is that it's awfully long. It's tough to get it into tight working positions. It also, the way that the crane is set up, it doesn't work in the negative, so it doesn't work below grade all that well. I don't know if it's because the angle of
Our system is below grade.
a lot of it is. I mean, so I have received feedback that I mean, as an example, there was a guy out here that was doing maintenance on our point. He was doing maintenance on the generator, and I thought everyone was going to go talk to him about what he was doing on the generator. People were more interested in his 550 with a crane on it. My point is that's what caught people. It's like, oh, how can you reach down into a pit and get stuff with this? How much can you haul? That was the questions that were coming up.
You think the Freightliner could be better utilized somewhere else, or maybe sold?
Yes,
We can use the assets.
that's what I think that's where I'm going with the whole thing is I don't know what we're going to get for it. I reached out to a few people. Conceivably, it's in the $55,000 to $70,000 range, and it is low mileage. Yeah, I don't know. We don't need to sell it.
Well, if it doesn't get utilized, I mean, nobody wants to drive it because it's hard to. So
If it's
no one
hard
wants to speak up,
yeah.
it's a lot of money.
Right.
I think we should cut our losses.
And it,
Use of that asset.
and I,
Make use of the money that's invested.
yeah, and have
Would the crew say what right vehicle the crane is for this job?
they like the 550. They like the 550. It can get into tighter spots. I mean, it's not as nimble as a Ford 150 or 250, but it's not a massive long base vehicle either. They like the 550. You know, if you were to ask them, what they would say is a 550 fitted with some tool racks on it and the crane. And if it was for picking up small pumps and things like that, that's what they would use. The flip side is if they need to get large pumps or get into really deep holes or a long extension, they'd call up one of the train operating companies that are down on the avenue, and we could have somebody lined up in a, you know, hours to days. Right? So that is kind of the beauty of living where we live, is that we have
A few hundred to a few thousand, that job is done.
right. Not everybody has OST down the street.
Is that on the top of the list of let's fix problem? On the top of the list, along with that.
It's second. I have the swap loader and the 550s, the switcheroo as a second tier. I think the important thing, frankly, is to talk about getting a vehicle, a light duty vehicle for that. And I didn't want to come back with two conversations and be accused of not telling the whole story. So the whole story is out there. Yeah. And then on top of that, it's just looking for maybe a recommendation on how long we would want vehicles in our fleet, right? And so I try to be cost conscious. Where I'm going with the whole thing is we have about $2.2 million worth of vehicles, right? And if they're going to run for about 10 years, that's about $200,000 per year of equipment. And what I did do is I outlined a plan that would, if you put $200,000 in reserves on every year, you could kind of run a 10 to 12 year vehicle replacement system in perpetuity. It has to be adjusted for inflation to $2024, but it's something that you could do. And then we're back to my initial conversation of when I signed off on the $750,000 gap backs. What I'm trying to prevent is me or anyone else in the future having that pop up on them as a surprise. Hey, we need to buy a $750,000 vehicle. That's the discussion I want to open.
That's one we need, because a $100,000 surprise.
When you're ready for me, let me know.
Anytime you want to jump in, Lowell.
Okay. When I read through this, I thought it was very well done. It was very well laid out, and I liked the timeline and the ups and downs of the reserve and the expenses and all that. I thought that was a very nice presentation. I've got two comments, I guess, or maybe three, but two for sure. One is I wouldn't hold myself to the 10 years, eliminate that as a criteria, stick with just the mileage. But I don't know that would really change, significantly what you've put together. I don't have a problem with getting a truck for the environmental guy, as long as it's a low cost, light duty, type of vehicle that I'm okay with.
That's all
And
that's needed.
I'm okay with the crane. I do think it's horribly embarrassing that we gave away a $250,000 used vac truck for $30,000 or $40,000, whatever it is. And we now think we're going to get 50 to 70 for this little crane anyway, I just think that was, today I noticed there was a district working around Denver. They had a vac system on a trailer, which made a hell of a lot more sense in terms of cost than these big trucks. But anyway, so those were my comments about that. I have no general problem moving forward with what you've suggested, recommended here. So
The crane truck, the Freightliner, is the crane transferable to a new vehicle?
Don't know. Look into that and get back to you. I don't know.
If you bought a 550 and is the crane in good shape? And it's just that the truck is too big to be as usable as it ought to be. Do something with that. And if we're only going to get 80 to 70,000 for a Freightliner with less than 10,000 miles on it, well, 10,000 miles. Maybe the crane doesn't make that much difference. I don't know.
Right. You're asking is, can we either part it out or find a better use for that equipment?
We don't have any hangar queens here. That's aviation talk. Not saving anything for parts. We're trying to use everything that we have. Other than we actually have all these 2, 4, 13 vehicles. Are they all out on the road every day? Well, not all of them.
No.
The FVAX probably isn't on the road every day.
The FX is not on the road every day. The camera truck,
Clearly isn't.
crane truck is not. The camera truck is not necessarily on the road every single day. I would say that they're used weekly, maybe with the exception of the swap loader.
Goal of expanding our collections crew is to try to have the CCTV truck and the gap backs out, so we can work back. That's because the other size of 2 free.
Yeah, right. Staff short.
Yeah.
So those numbers should improve. I'm with Lowell on this. I think we should have a policy putting together money every month that goes into a reserve. We have a vehicle reserve.
Yeah, it's, you would do it at time of budget, when you put your money into your
Yeah.
reserves, unless you're transferring something that was a surplus, like upon reconciliation of your budget. So your policy would adopt something, a contribution that you would do at time of budget.
It needs to be adjusted. And immediate need for a Ford Ranger should be brought up at the beginning.
Yeah, that should be the Maverick, you mean?
Yeah, so I envisioned a Maverick. Found out that they can't sell them right now because they're, at least when I spoke with them 3 or 4 weeks ago, there was a recall, and so they put a stop of all sales of Maverick. But yes, wherever I'm envisioning a small pickup truck, whether it's Maverick, yes, something smaller than
A 4-cylinder?
Yeah, I think it is. I think the Maverick is. I think
Ranger 6, V6.
maybe.
Why don't you get a Tesla truck?
Breaking up. Oh,
Will's tired.
The truck
Or-
vote against the Tesla truck.
You would vote against that? Okay, well, I would
Looks
concur.
neat. You know, in the paper, every paper in Ventura. You don't want that.
No, probably cheaper than this. Like,
Put somebody else's logo on the doors. I think.
All right,
I think
I lost
start-
that discussion.
10 years, that's a pretty aggregate. Yes. You're saying, because as we have come upon over the last year or so, as we've talked about individual vehicle replacements, every one of them lasted 50% longer than its average life.
yeah. I'd have to go back and look at my spreadsheet in particular, but I think I think it's conservative at the 10 years. If you wanted to kick it to 12, you probably could, and the reserve fund would build, and then you would mitigate things. But
I'd just kick it out altogether, just go.
I don't
on
think
mileage.
planning is the time to penny pinch, right? You kind of during planning, if you want to make sure you can make it work in situation.
Oh, yeah. I personally have only had one car I kept for less than 10 years. What I tend to worry about is once you get much beyond 10 years, commercial vehicles, that maybe it's a different metric, start to run into some parts problems. Wheels wear
Yeah,
out. like that. So
Yeah,
somewhere between 10 and 12 years, I think it's a good planning interval. But we're still evaluate each vehicle as we get to it. But yes, also it should have a nominal mileage measure as well. Particularly the big stuff like gap facts. We're not using it, not using most of the vehicle most of the time. Using pumps, the engine. Is that about right?
Yes. Yeah, the transmissions, the,
Worry about seals wearing out, cracking. But the rest of it is going to pretty much be in good shape.
Scott, you were, page 26, has a cost at the paragraph at the bottom of it. Is that the gist of what is being asked to recommend to the board?
Yeah.
To consider? Yeah. 200,000 a year?
yeah, I think if you, my rough, $200,000 a year in 2024 dollars. So that's how this is all.
We can look at inflation each year and.
Yep.
What do you guys think about that? It's pretty simple.
It is the prudent thing to do. My thought, whether 200,000 or 180 or 225 is the right number, don't know. That's
yeah,
a
right.
statistical thing. I've always had this hierarchy. There's truth, lies, damn lies, and then statistics. Really the statistics here. As long as we try to make a prudent investment in vehicle replacement, and then evaluate each vehicle as it comes up for replacement. I think we've done the right thing by the district and the right thing by the ratepayers as well. Lowell?
I agree. And my wife's dad was an engineer and he used that same comment about statistics. So
Oh,
I've heard it before.
So maybe we should recommend that Scott, in this paragraph, along with some supporting numbers.
all of these numbers here are other people's numbers. It's the table 3 that is our stuff.
Would you think that this is a really high priority? As far as the next board meeting with?
Yeah, I can make that fit if that's what you're asking. And then I do think it's a high priority. Move on for the pickup truck for the inspectors is paramount. And I think it's also paramount that we kind of get this outlined as we come into budget season.
I think that's exactly right. We need to expense that Maverick Bronco or whatever it turns out to be. I think we should do that yesterday, 2 weeks from today.
Across the Bronco.
Today. Whatever. A white Bronco. Right?
If for some reason you have a delay in getting that, I'm perfectly willing to let you guys use my old 2004 Volvo 4-wheel drive wagon. So
Always a solution.
Yeah, I think both the immediate purchase of the environmental inspectors drive and getting plan for replenishing the vehicle replacement reserve on as something the board thinks needs to be in this year's coming budget. I would say those are both high priority.
yeah,
Sure.
I agree.
That's what I would recommend. Yeah.
I'm not stuck on Ford. There's maybe a GMC or Chevy that are okay too in that price range.
Said Ram.
Anyway, let's let the staff sort it out.
discussion.
There another? We come to the end of the report,
Come to it, yeah.
of the discussion item. Any committee members? Anything to add?
I have one, and I can't remember if I brought it up at the last meeting or not, but they had a big LiPo battery fire up in Monterey at the power plant at Elkhorn Slough. And
Yes.
I just
Moss
hope
Landing.
yeah, Moss Landing. I'm hoping that we're kind of keeping our eye on that and see if there's any learnings that come from that that could affect how we treat our batteries. I guess
We
I
have
did
a
bring
lot of
this up at the
lithium
last
ion
meeting, but-
batteries in the fleet right now.
No, well, we've got our power systems.
That's the
using
buy
it.
it at night, use it in the daytime storage.
Yeah, our Tesla batteries. Yeah. So anyway, just as a reminder that happened, and we have some batteries that could have issues if we just need to pay attention to that. See
Yeah,
what comes out of it.
I can give a quick update on that. I heard you had a similar comment at a week ago. We did look into it. Liz and I looked into it. The one thing that we did find out, and it's up for a conversation internally, is if there was a fire in our battery, would that disrupt our switch that automatically switches us over to generator?
For power.
Yeah. Well, the answer was when it comes to prime power, it's going to shut down the prime power. That's a guaranteed. So if our battery catches on fire, we will lose. The only way that they can isolate that battery is to shut off our service from Edison. So we realized that.
Yeah, okay.
And what we don't know yet is whether or not we can get our generator, will the automatic transfer switch flip on, or will that be part of the fire in essence? And that's what we're trying to hash out with our electrician.
Would be pretty important.
Right. That's exactly it.
Right, yeah, I guess the Tesla batteries hang across the prime power. If they blow up,
Power comes through their islanding structure into the batteries and then back to our MSB.
they're in the way. Okay.
So the answer a little bit is to your question is we are watching. I'm not really looking at the details that happened at Moss Landing, but for our purposes, we're looking at it, make sure it's not, we're trying to do what we can to not have a detrimental
Yeah.
outage.
Yeah.
Oh, good. I'm
So
glad
give
you're
us any
aware of
kind
it.
of
I'm glad you're
warranty
thinking
on
about
that battery bank?
Yeah, we have 10 years of O&M built into the funding, so that goes through, I think, 20. But they are anticipated to have a 20-year life. So we're gonna have decisions to make at the 10-year and 20-year mark. Also think we talked recently at a board meeting about having someone to do our emergency response plan session. I think this will end up being piece of that, that'll get evaluated by external,
So
environmental response plan specialists.
warranty is one way you things running. Other is insurance. What sort of insurance do we have?
Oh, for there, I don't know. Look into it. Insurance, just like this.
Fire in our.
If the battery banks blow up or melt down,
I mean,
then we're running on generators till we can bridge the banks from prime power.
met with Taft and talked about it and basically them in as an emergency. They'll come in and we will bypass our batteries and connect directly into our MSB with air
Right.
and restore how we used to have it. And then the batteries are going to be offline.
Bypass switch is not part of the current installation.
Automatic transfer switch if we lose primary power that our generator fires. But right now, the primary power is routed through Tesla's islanding structure into the system and then back to our MSB. They would pull the wire that goes to the islanding, place it with new wire that goes directly from Edison back to our MSB. So we'd be back to how we were prior to the batteries being installed, hopefully within about 72 hours or less. Be a major emergency. Taft's clock and we Edison. It'd be a major problem. And once they start smoking, you can't put it out. create a safe perimeter, just like that Volvo.
That's right.
that did intent.
Yes.
Once smoking, you're done.
Stand back and let it burn out.
That's what you got to do.
Are remotely monitored for 7.
Well, I'm sure we're keeping track of it. I just wondered what Plan B was.
And then there is some that will be proposed to, there's some bypassing that can happen from a mental standpoint with these battery systems. And they're proposing that no longer get bypassed because I think that one of the energy affairs missions kind of says, yes, we want to do a lot of batteries. Now they're starting to say with these major emergencies that are happening, environmental catastrophes, these plants, hey, maybe we should pass. So they're trying to prevent them from being the rivers, prevent them from being sensitive
The
environment.
battery on the prime power certainly smooths out prime power too.
Yeah, I know.
It's a big help that way. Okay, anything from the general manager? You want to add?
No,
Can I add one? Can I add
Yes,
one more thing
please.
to this whole battery thing?
Sure.
One of the things that we've been discussing is how you transfer power and all that sort of thing. But once they start smoking, we may be required to abandon the plant. And so if that's a possibility, that creates a whole nother set of problems. How do you do that? How do you shut things down? Where do you go? All those sorts of things. So again, just be aware of all that, because I think they did end up evacuating.
Part of our emergency operation plan,
Yeah,
does the plant do batteries catch on fire? That should be looked into. Something at least sketched out.
yep. All right. Well, that's all from me. Sorry.
Thank you. I don't have anything more.
No.
Good. Scott,
I have nothing more. I appreciate your time.
6:35, we are adjourned. Thank you all.